Ja, Asien ist ein immer wieder spannendes Thema, mit dem sich nun Jason, Investment Manager im Asian Equity Income Team von Jupiter, auseinandersetzen wird. Jason, you are very welcome.
Thank you very much. Good to see all of you.
Bevor Jason zu Jupiter kam, arbeitete er bei Newton, wo er das asiatische Aktienteam leitete und eine Reihe von Fonds. Davor war Jason bei PP Pension Fund für die Aktienauswahl und die Aktienallocation in der Region Asien verantwortlich. Er begann seine Karriere 1993 bei Henderson. Ja, sein Thema: Asien als Anlageregion für regelmäßige Erträge und Kapitalwachstum. Jason, the floor is yours.
Okay, thank you. Good to see you all. So my purpose is to make investors as much money as I possibly can whilst investing in the Asia-Pacific ex-Japan region. We pick 30 stocks and we're top-down stock pickers. We don't feel compelled to invest in all the countries in the region, but we certainly invest in developed countries like Australia and Singapore and emerging markets such as India and Indonesia. We don't like investing in communist dictatorships or autocracies. So just to give you some reassurance, we have no investments in North Korea or Vietnam or even mainland China, which makes us quite different from many other Asian investors. We much prefer to invest in democracies. We like to invest in countries that have the type of rule of law that we would all recognize, i.e. an independent judiciary, and where the goalposts can't be changed willy-nilly. So we like to be risk-averse whilst investing in what we see as a very exciting part of the world. We certainly see that there are decent absolute return opportunities available to us, and over the long term, this strategy has delivered decent absolute returns. The way that we're trying to generate returns is from a mixture of dividend income and capital growth. So we are investing in companies that have an ability and a willingness to pay dividends. We're investing in companies with strong balance sheets and decent free cash flow generation. So of the 30 stocks that we invest in, 7 have a net cash balance, and the other 23 have low levels of debt, low levels of gearing, leverage, relative to their business model, i.e. relative to the visibility of earnings and cash flows. So we absolutely value dividends. It does help make the fund or the strategy low beta. So it does have a very strong track record of outperforming when markets fall. But that said, over the long term, the strategy has outperformed a rising market. And part of the way that it's done that is to have shallower drawdowns when the market's gone backwards. So I'm going to run through the presentation, which doesn't take too long. Please do interrupt if you have any questions as I go through, and there will be time for Q&A at the end. A few key characteristics of this strategy. Because it's naturally low beta, we do keep it fully invested, and that means cash between 0 and 3%. The fund is income hungry. We get a lot of income from being invested, and also, if I'm very cautious on markets, I could be wrong. So I'm never going to run up a large cash position. I will keep the strategy fully invested, and we see that that's what we're paid to do. As I mentioned, we only have 30 stocks, so there will be fairly high tracking error, fairly high active share. We're very, very selective about every company that we hold in the portfolio. We don't hold anything simply because it's a large index constituent. And that's it as far as investment goes. There are no funny bells and whistles. We don't use any form of derivatives. There's no currency hedging, and there's no gearing. We are long-term investors. So when we decide to buy into a company, we'll take a 5-year view on it, and many of the holdings end up in the strategy for longer than 5 years. So for us, it's a really big deal to sell out of a holding and indeed to buy into a new holding. Year to date, we've only sold out of 1 stock and bought into 1 other stock. And the pattern of the turnover of the strategy is often that we'll have a long period where we don't make many changes at all, and then there may be a flurry of activity where we want to raise the weighting of a sector or reduce it, or the same thing for a certain country. So in July last year, for example, that's when we sold out of the last 3 mainland Chinese businesses we owned. In July last year, we decided this is not a country that we are comfortable investing in. Let's sell out. Let's put the money elsewhere where we're much more comfortable. And there are plenty of opportunities, plenty of safer opportunities elsewhere in Asia. And we certainly believe that was the right thing to do long term, and in the short term, it has already helped. The process is that we're top-down stock pickers, as I mentioned. So we have to have an understanding of the macro environment that we're investing in. That means understanding the economic environment of each of the countries in Asia, and also how Asia is impacted by what is going on globally. So we do pay close attention to what is going on in the US, Europe, and elsewhere. It also means having to have an understanding of the politics of the region and what is going on globally. If we stand back for a moment, I think as investors, we have to see that there are 4 key groups of people that move markets. There's us, the capital allocators, and we have to observe what the other 3 groups are doing. And they consist of politicians, whether we like it or not, because they do change laws which impact markets. Consumers, of course, and how spending patterns change and why they're changing. And then business managers and how they're adapting to the other 2 groups in particular. So politicians, they do move markets. And that's why we have to have an understanding of the political system of each of the countries that we're investing in. And as I said, how geopolitics is impacting the region. The way that we value businesses is largely twofold. PE, and measuring the dividend yield against the risk-free rate. And for that, we take the 10-year government bond yield as a proxy, and in a moment, I'll show you how they compare in the key markets that we're investing in. We do think about environmental risks, but we don't try and describe this as the greenest of strategies. I don't want to say anything that could be interpreted as greenwashing. We are very much pragmatic when it comes to investing. And as I said earlier, my main objective is to maximize returns to investors. But when we think about the environment, we do think about physical risks, but also the risks that come from politicians changing laws because of their view of the environment, and consumers changing their spending patterns because of their view of the environment. And actually those 2 risks, we think in the short term, are greater than the physical risks of climate change for many businesses out there. Demographics is often overplayed. Some people talk about it too much, and it can be a very long-term trend and not cause short-term changes in markets. But having said that, there's one country in my region where demographics, the demographic profile change really is making a difference, even in the short term, and that's Australia. Australia has one of the best demographic profiles in the world. The population is growing very rapidly, and this is because of skilled and/or wealthy immigration. More millionaires move to Australia than any other country in the world right now. That includes the US. And when people arrive on your shore and they can either get a job quickly or they don't need a job because they're so wealthy, that can make a dramatic difference to your economy. And it's a much quicker impact than having to wait 20 years from somebody being born, going through their education process, and then getting a job. And we talk to a lot of domestic-focused companies in Australia who are citing the rapid rebound in immigration following the pause in the COVID years as a reason why they're very optimistic about their businesses. And certainly the Australian economy is doing quite well at the moment. Interest rates may well need to have to go up further because of this, because unemployment is at a record low. And after a period of decline in the last few months, house prices are picking up again, despite the fact that interest rates have been going up. When we think about liquidity, we think about it from a macro point of view and a portfolio level. Liquidity is very important. I've been investing in Asia for 30 years. I began my career in 1993. I have seen periods where liquidity has dried up. We certainly do not want to be invested in any area where there is a risk of a liquidity crunch or a credit crunch. And when interest rates have been going up for a period, we're more at risk of that. So we do tend to avoid the less liquid markets, and the portfolio itself is very liquid. We only invest in large cap companies. I will show you the market cap profile of the portfolio in a moment. Once we've decided which countries we're comfortable investing and which sectors we're comfortable investing in. Then we think about the companies themselves, and we are trying to pick the very best candidates for this portfolio. We meet companies frequently, we go into meetings armed with questions, and we're always trying to get a refreshed sense of what a company's competitive advantage is, what are the barriers to entry to their sector, if any, how do they deal with technological changes, or indeed are they drivers of technological change themselves? And this will be a question for companies in all sectors, not just the tech sector. And clearly right now we've got to ask about the risks of cyber attacks. We know that every major company out there is facing hundreds or thousands of attempted cyber attacks on a daily basis. So we need to understand how they're repelling these attempted attacks and what they would do in the event of a successful attack. So this is a big risk that I think many investors are still underestimating. And there's one book that I would highly recommend that you all read. If you take nothing else away from this presentation, I would urge you to read this book. Please don't be put off by the title. It's called This Is How They Tell Me the World Ends. It's been written by an American lady called Nicole Perlroth, who writes for the New York Times. It's a very in-depth study into cybercrime, cyber terrorism, cyber warfare, and I think if your knowledge of this area is fairly limited, you will find the book quite an eye-opener. So we ask about that. Of course, we ask about AI, artificial intelligence. I believe it's known as KI here. This will present opportunities for some companies and risks as well. Over time, it ought to improve productivity for many economies, and many incumbent businesses will see their productivity improved if they use AI, KI effectively, but if they don't, they might find that their business model is blown out of the water by a disruptor. So we have to understand what the strategy of companies is when it comes to this area. I've talked about balance sheet strength. It's always important for us. But when interest rates have been rising for a period, of course, it's more important than ever. We took over a fund that had been managed by different colleagues of ours at Jupiter in March this year. So I have to show you these performance numbers of the fund itself, which is available here in the German market. It's an ICVC, a Dublin domiciled fund, but I've only had a relationship with this fund since March, so it's not particularly useful from a historic point of view. I will therefore show you the performance numbers for the strategy as a whole. This is something that I launched at Jupiter in March 2016, and I've been managing a similar strategy with a different firm since 2005. This strategy is first quartile over every time period, year to date, 1 year, 3 year, 5 years, and since inception. In fact, over the last 3 and 5 years, we believe it to be in the top 2% of all Asia-Pacific ex-Japan funds. Coming back to how we value companies, for us, looking at what the bond market is doing is very important. You can't separate equity prices from bond prices, we feel, and a lot of equity managers probably are fairly unaware of what the bond markets are doing, but for us it's essential as a valuation tool. What you can see on this slide is the 5 markets where the strategy has most of its money invested: Australia, Taiwan, Singapore, Korea, and India. And on this slide, you can see that the orange bar is the equity yield we're achieving from the stocks that we own in these 5 markets. The dark blue bar is the 10-year government bond yield in these markets. So in 4 of the 5, Australia, Taiwan, Korea, and Singapore, we have a spread nicely in our favor. Equities are yielding more than bonds by some way, and on top of that, over the next 10 years, we're confident of dividend growth, whereas the bonds have a fixed coupon. So when we look at this, it reflects to us what we see. It shows to us that there's a lot of value in our portfolio in the stocks that we own. The exception by this metric is India. India very much is a growth market. It is a structural growth market. It isn't cheap, but we're not investing in the market as a whole. We're investing at the moment in 5 specific companies. The 5 companies that we own together on average do yield about roughly double the equity yield in India. but they are dragged down by one or two having low yields. We own one Indian stock, for example, which only yields 1%. And you might think, well, 1% is a very low yield. Why would you have that in an income fund? It's because they're growing the dividend at a fairly steady 20% per year. And we're trying to populate the portfolio with a mixture of lower yielding stocks where the growth will be very steady and sustainable, and higher yielding stocks where naturally growth won't be as high. But we don't paint ourselves as either growth or value investors. We're greedy. We want both growth and value. When it comes to India, though, it is a growth story. So we have to look past this valuation metric and identify companies where we think the growth really is sustainable. But I'm pleased to say that the Indian stocks that we've bought into as a portfolio have done very well. We've outperformed the Indian market by some way in the last couple of years, and India has been a key contributor to the strategy's overall outperformance. We are large cap investors, and on this slide we give the 6 key reasons why we prefer large cap companies, but I'm just going to focus on 2. The first is, I'm not a good small cap investor. Earlier in my career, I used to invest in companies across the market cap range, but after a number of years, I realized that I should leave small cap companies to other people. I'm not very good at it. Sometimes they worked, sometimes they didn't. Overall, they really didn't make a difference. I've never invested in unlisted stocks, and since arriving at Jupiter, I've focused on large cap companies where there is further room to grow, and that's the key thing. So companies that have already proven themselves, but where their business model is scalable and there is much further room to grow. If you think about it, in the US now, we've seen a number of businesses hit that market cap number of $1 trillion or more. Now, once upon a time, they would have had a market cap of $50 billion, and at 50 billion, they would have been considered large cap, but they've grown a further 20 times from that point. So this is what we're looking for, large companies that can grow much further. We don't invest in any company with a market cap of less than $3 billion. The vast bulk of this portfolio is in companies with a market cap of over $10 billion. So it is very liquid. This is the country and the sector asset allocation of the strategy. So on the left-hand side, you can see the country weightings, and there are clear differences with the benchmark. That 0 weighting in mainland China is a very big difference, and that's offset by the big overweights in Australia and Singapore. We're also overweight India, and to a lesser degree, Taiwan and Indonesia. And within these markets, we feel that we've picked the best of the developed countries in the region and the best of the emerging markets in the region as well. In fact, over 50% of the strategy is in just Australia and India. In our mind, the most exciting developed market in the world, Australia, and the most exciting developing market in the world, India. When it comes to sectors, we're a bit more closely aligned to the benchmark. I think that's natural, because in the large sectors like IT and financials, we will always find businesses somewhere in the region that we like, even if they're not the Chinese versions. But there are differences with the benchmark. You can see we have nothing in the healthcare sector. We have invested in that sector in the past. We'd like to invest in that sector, and we keep looking. But at the moment, we're put off by valuations. All the best healthcare companies, whether they're pharmaceuticals or hospital operators, they're all very expensive, certainly in this region at the moment. We remain overweight consumer staples and underweight consumer discretionary, and this is because we don't think the growth outlook across the world over the next year, 18 months is particularly exciting. We do want to keep the portfolio fairly defensive, but those are weightings that can be adjusted when we see opportunities. We always have full transparency over the whole portfolio, not just our top 10. So on this slide, you can see every stock in the portfolio. And I'm very happy to explain what any of these companies do, if any of you would like to ask. Those in the lighter shade of blue are our top 10 holdings. And again, this highlights that for us, there are 5 key markets: Australia, India, Singapore, Korea, and Taiwan. That's where we have the most money in total, and that's where we have our top 10 holdings, so individual stocks with the highest weightings. In some of these markets, we're playing domestic consumption mainly, and India, Indonesia would be examples. In some of these markets, we're playing the global economy or exporters. Taiwan is a very good example. We only have 3 stocks in Taiwan, all of which are in the tech sector and sell their goods all around the world. And then in some markets like Australia, Korea, Singapore, it is a mixture of playing domestic demand, regional demand, and global demand. Another way to break down the portfolio is like this. So here we've shown you, again, every stock in the portfolio, but split by sector and also by yield range. We have amalgamated a couple of the sectors just to make it easier on the eye. So utilities, telecom companies, and toll road operators, we've bunched up under infrastructure, just to make it simpler. But you can see here we're not reliant on just 1 or 2 sectors for the high yield, for the high income. We've got a number of different sectors where we have stocks that are still growing, that have yields of over 5%. We also have a number of companies where the dividend yield is less than 3%, but here we are confident of dividend growth going forward. Now, 2 of the companies that we hold in this portfolio have been bid for so far this year. Newcrest Mining, which is a gold miner in Australia, has been bid for by Newmont of the US, the largest gold miner in the world, at a very nice premium. We were happy to see that. And we may end up remaining shareholders of the combined group. It is a scrip offer. We will receive equity in Newmont, and they have said that they will retain a local listing in Australia because a large proportion of their assets will be in Australia. But we've yet to, there's no rush, we've yet to decide, but we expect at the moment we'll remain shareholders. And then NWS Holdings in Hong Kong has been bid for by its parent company. This time it's a cash offer, so we will receive cash. We're quite pleased. It's the least liquid stock in the portfolio, so it's all going to go in one fell swoop. And we've been thinking about what we will replace that with. We had a meeting with the CEO of a very large company earlier this week. We've got a meeting with the management of another company next week that are, let's say, the top 2 on our watch list for when that happens. So we're always thinking about where will we put money if we need to deploy new money. Similarly, we're always thinking which are the weakest constituents in this portfolio if we want to sell something. This slide shows you my longer term track record, including my days at Newton Investment Management, which is part of BNY Mellon. I launched the Newton Asian Income Fund in 2005. It was the best performing Asian income fund in the world. I took that from 0 to, at its peak, $8 billion US, and then have continued at Jupiter with a very similar strategy since, as I say, March 2016. And since the launch of this one, I'm pleased to say it literally is the #1 best performing Asian income fund. So if you look at any Asian fund with a dividend yield of above 3%, this is the best performing one. You can see that the orange line is a bit straighter than the 2 blue lines. There's less volatility to it, and it has outperformed the benchmark over the long term. And the trick to that has been to have shallower drawdowns when the benchmark has gone backwards. And this just goes to show that it's very possible for a low beta fund to outperform a rising market over time. This shows you some of the team of people that I work alongside. There's not enough room for photos of everybody, but I co-manage this strategy with Sam Conrad. Sam has got 18 years experience following this region. I've got 30 years. We've got a large emerging markets team. We've got a Japan income team, which is managed in a similar way to this. We have a number of different global equity investors, including Guy de Blonay, who we share ideas with. We have a large stewardship team who advise us on how we should vote at AGMs and EGMs. Not shown here is our very large and successful fixed income team, and it's always useful to hear their views on the outlook for interest rates and inflation, etc. Other slides relate to risk control, ESG philosophy and approach, etc. But I'm not going to dwell on these because I do want to open it up for questioning. So just to quickly sum up, as I said at the outset, my purpose is to maximize returns for investors in my strategy. I believe that I am investing in an exciting part of the world. We do take a low risk approach to investing in this region, and so far it has worked. So thank you very much. I'll be happy to go into anything in greater detail. Thank you.
Jason, thank you very much. There's the first question, please.
Why don't you invest in Japan? Because a lot of investment managers are at the moment very optimistic for this market.
Yes, it's partly for historical reasons. So when I began my career, the Japanese market was so much bigger than the rest of Asia combined, and so Japan was done separately. And I'm probably too long in the tooth, too old to start covering a new market now, and we do have a separate Japan team, and I wouldn't want to tread on their toes. I certainly find that there's enough to invest in my region, but Japan may well complement what we do, so I wouldn't advise for or against it as an investment, but I do think Japan is a very mature economy. It is quite different from a lot of the countries that I invest in. So, you know, I'm happy with my area, and I believe that it's big enough.
Yeah, great presentation. Question, how did your China exposure evolve over the last 5 years? When did you go to zero?
Yeah,
and what would be your taste on China? Is there ever be a time when you will return to China, and what do you need for it to happen?
There's a very good chance that for the rest of my career we won't invest in China because what we need is not likely to happen. But let me answer the first part of your question. So the peak weighting that we had in mainland China was probably in the summer of 2020. China had outperformed it over those few months, and we had in the low 20s. So at the very highest level, we had about 22% in China in midsummer of 2020, and that was up a few percent from where it would have been a year earlier than that. But from that point, we took it down in stages. So you know, we would sell 2 or 3 companies at a time, and by July last year we got down to the last 6%, which was in 3 stocks, and then we sold those 3 together. It was partly or largely due to politics, the caution that the intelligence services of the US and the UK were voicing quite publicly about how they see China as a strategic threat going forward. We'd seen that internally China appeared to have become more repressive. There was far more government intervention in private companies. If you're a company of any size in China, you're pretty much forced to have communist committees within your company. If you become quite big, there's probably going to be a communist representative on your board. And if you become a mega cap, like Tencent or Alibaba, the government will take a golden share. And we just don't like too much government intervention. We like companies to have as much control of their own destiny as possible. I know that elsewhere in the world, companies aren't completely in control of their own destiny, but China has reached a point where we don't think entrepreneurs will be as excited to grow their business there. We think more of them will be compelled to, if they've got a great idea, to go elsewhere to grow their business. And given that we have so many exciting emerging markets and developed markets as well in our region, we just don't see the need to be in China. What it would take for us to reinvest would be a political change. Now, if you look back decades, sometimes political change can happen quite swiftly. You know, in the late 70s, I think many people would not have expected that the Soviet Union would have broken down within 12 years. I don't think it would happen as quickly in China. There'd probably have to be an event. But China's economy right now is in a real mess. It really is. And we didn't get tempted to get excited again about China at the end of last year or earlier this year, when a lot of people were saying, well, they're now opening up. They've abandoned their zero COVID policy, and now the economy is going to rebound. We did not buy into that, and sure enough, it rolled over fairly quickly. And now we're getting a lot of data out about the high debt levels of local governments, the real problems in the property sector where leverage has been too high, and generally growth is on a downturn. So that people who are bullish on China all they've got to go for them now is they're saying, well, actually things are so bad that the government's going to have to stimulate the economy. And that's the only thing they can hang their hat on, saying, well, it's so bad, the government's got to do something. And if you're relying on the government doing something when there's probably been a huge misallocation of capital already in that economy, I'm not sure that's the best thing. So I'm not saying we don't look at China. We probably read more about China than any other country, but most of what we read reinforces our view that that's somewhere to avoid because there's plenty of other opportunities elsewhere.
May I ask you something about performance attribution, about your outperformance during the last 2 or 3 years? How much is the impact of your Australian overweight to that?
So when we look at our attribution, in the last 2.5 years, so year to date and the previous 2, Australia is consistently in the top 3 of the countries that have caused our outperformance. The other 2 being India and China because of our big underweight. And within Australia, it's been a mixture of being overweight the market and the stock selection, the stocks that we've held there. We do have quite a diverse mix of companies, and by and large, they have done very well for us, and the higher weighted stocks have tended to have done better. So last year, Woodside Energy was one of the top 2 best performing stocks in the whole portfolio. This is an oil and gas producer. Year to date, Newcrest Mining has been one of our best performing stocks, partly because it was bid for. And you know, a number of others have held up very well. Some of them have very high dividend yields, and so part of that total return has come from income. But generally, Australia has been a big help to performance over the long term and the short term. Australia's got a lot going for it. For us, we see it as a small version of the US. It's like America in many ways, but a smaller version. It's a land that has many first, second, third generation immigrants who are very keen to improve their lives and industrious. It is a fully functioning federal democracy. It's a functioning democracy in the sense that people accept elections, they move on. And I would say one difference with America is the democratic system is more peaceful, less at loggerheads than America. One other difference is that government debt to GDP is quite low. In Australia, it's only 51%, which is one of the lowest levels amongst developed markets in the world, a lot lower than most of Europe, the UK, Japan, the US. And we do see the currency as intrinsically a hard currency. Now, in the short term, of course, it does move with commodity prices, but over the long term, it's simply gone up and down within a band against the US dollar. It hasn't steadily depreciated like a lot of other commodity-linked currencies, and that's because Australia is an exporter of lots of different commodities, not reliant on just one or two. In fact, every major commodity you can think of, Australia is a net exporter of, apart from crude oil. It's a net importer of crude oil. But the big positives are the demographics and the fact that it is tied into the Asian growth story in a positive way.
Some more questions? Yeah? Okay, thank you.
You mentioned the Chinese economy, and my question is, how big is the influence for the Australian economy? So how dependent is Australia from China?
China is the biggest source of Australia's exports, or the biggest destination for Australia's exports. So Australia does sell a lot to China because China remains a large consumer. But it doesn't have to sell those commodities to China. It sells the commodities to whoever wants to buy them. And the fact is, China remains the largest buyer. But if somebody else, or a number of different other countries, picked up their consumption of commodities because infrastructure spending increased, then Australia would happily redirect its commodities. But for the moment, China remains the biggest buyer of many different commodities. So from a trade point of view, China is Australia's biggest trading partner by far. But the commodity sector doesn't dominate the Australian economy as much as many people assume. In fact, in a direct sense, it's only 10% of GDP. Many other sectors have developed quite well in Australia. Not manufacturing, but the service sector is huge. Tourism, education, the tech sector is picking up. A lot of tech entrepreneurs are attracted to Australia because of the rule of law. The fact that they speak English reasonably well is seen as a positive. And entrepreneurs are attracted by funny things. A lot of the reason that they flock to California is the weather, the beaches, the lifestyle. Well, they can find that in Australia as well. So, of course, there are cycles. Australia, if we see a deep recession in China, Australia is not going to be immune to that. But in years where there have been global recessions or Asia as a whole has struggled, Australia has still actually been quite defensive. So in 1998, for example, when you had the Asian crisis, the Australian market outperformed Asia as a whole. We have a number of companies in Australia that sell to the whole world. So Amcor, top of the list, for example, it's one of the largest packaging companies in the world. It grew up in Australia, but only 2% of its revenues now come from Australia because it has such big operations in North and South America, Europe, and Asia. Macquarie Group is the world's largest manager of green infrastructure assets, things like offshore wind farms. So 30% of its earnings come from Australia, 30 from, well, closer to 40 now from North America, 30 from Asia, and then 10 from the rest of the world. And then we've got some companies in Australia that are quite defensive, such as Transurban, the biggest toll road operator there. And they're far more aligned to the growth in the population than what's going on in China. But I guess what I would say is if Australia is struggling because China is having an economic problem, then the fact that we have nothing directly in China is certainly going to help us in a relative sense against other Asian funds, more so than the negatives that we'll see from our Australian weighting.
Okay, last question, please.
In your opinion, do you see more cooperation or do you see competition between India and China?
Yeah, that's a very good question. I think India and China are natural rivals. The West, led by the US, but you know, many of the democracies in the world are making sure or trying to engage with India to make sure that longer term India is on the side of the world's democracies and helps contain China. And India is being allowed to get away with things that other countries might not be allowed to get away with, in the sense that they're still very close to the Russians. India imports a lot of cheap Russian oil, refines it, sells it on world markets, and that's kind of overlooked because the Americans are looking longer term at China and just want to retain a close relationship with India. So I think they are the two key powers in Asia in the long term, you know, far more than Japan or anyone else, and therefore they will be natural rivals. They are very, very different countries. They have different cultures, clearly different political systems, and it will be far easier for India to retain good relations with most of the rest of the world politically than it will be for China. So whether they'll become more antagonistic, I mean, they have clearly had clashes on their borders over the years, but both are nuclear powers. I wouldn't expect them to have an intense rivalry. But yes, I do think they're not going to be close buddies anytime soon.
Okay, thank you
Okay,
very much.
Thank you very much. Thank you.